Hello, everyone. Today on the Final Bar, I'm joined by Andrew Thrasher from Thrasher Analytics, joining us from Indiana. We're going to talk about the S&P 500's continued climb higher, with the S&P trading just above 4420. It looks like for the close, testing an all-time closing high yet again. We continue to see pushing to the upside, even with plenty of evidence to suggest we may see lower moves, but energy and healthcare driving things higher along with some of the cyclicals today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets and on the activity of the markets through the lenses of technical analysis and behavioral finance. Let's focus on the message that the markets provide. If you know nothing else about the S&P 500, look at a chart of the S&P 500. I would argue that is going to give you much more information than you could get from looking at many articles and commentary about what the markets should do. Focus on what the markets are actually doing. And when you measure the pulse of the market in terms of the action of the S&P 500, it's hard to think of anything but constructive. Higher highs and higher lows are an uptrend. I mentioned that on the show many times. That's the Charles Dow Technical Analysis 101 strategy. And it's so funny how often we get away from that. It does not serve us well, right? Focus on the trends. The S&P continues to make higher highs and higher lows. Until that pattern changes, the path of least resistance certainly seems to be higher. However, as we've talked about again recently, we see plenty of evidence of potential exhaustion. Stocks that broke out, that have failed and have not held up those previous highs. Amazon comes to mind. Breadth data that has been weakening, et cetera, et cetera. We'll try to tease out as many of those pieces of evidence as we can today on the show. We have a great guest today, Andrew Thrasher. I'm excited to have him join me again today. Tomorrow, on August 4th, we have Sam Stovall from CFRA Research. He literally wrote the book on sector rotation, so excited to hear his take on the world right now. On Thursday, the 5th, legendary technical analyst Mark Chaikin joining the show, sharing with us some of the indicators he's been using recently to combine fundamental and technical indicators. Next week, on Tuesday, the 10th, we have Gary Dean from sentimenttiming.com. And then on Wednesday, the 11th, Samantha Leduc from Leduc Trading. If you've missed any of our previous interviews, by the way, and there have been some fantastic discussions on the show, go to StockChartsTV.com. You can watch all of our previous interviews on demand. Let's continue on with our market recap here. We'll start with a poll. We often have a poll running on our StockCharts TV live stream page right off of our main website. Also on social media, we'll send a poll out a couple times a week. Recently, we asked you, how much time do you spend looking at charts on an average weekday? I am very happy to see that 55% of you said 1 to 2 hours. 25% of you said, 10 minutes to an hour, which means a grand total of 80% of you that responded are looking at, I would argue, a decent number of charts. I'm concerned about the 5% of you that look less than 10 minutes in charts, because as quick as you may be in analyzing charts, that is not enough time, I would argue, to really make sense of things on a weekday. Your morning coffee routine, which should hopefully involve a good amount of charts, should take more than 10 minutes. So I focus on that. I'm also concerned and somewhat skeptical of the 16% of you that said, and I quote, even Dave Keller does not look at this many charts. I challenge you. Although Andrew Thrasher, my guest today, may actually have me beat on that. He would have correctly answered in that one. But the point of that was just to encourage you to think about how much time you spend looking at charts versus other inputs. And again, I would remind you that I think charts can be a great way of illustrating market dynamics. All the other stuff are ways to qualify and validate some of the things that you're seeing on the chart. Let's start with the chart. Continuing with our market recap, the S&P certainly reacting to yesterday's distributive move to more of an accumulative move, more of an accumulation phase today, bouncing higher, really, a bit of a down move out of the open, but turned left very quickly after the first 30 minutes and finished strong today with the S&P closing above 4420 to around 4423 and change. The NASDAQ 100 and the NASDAQ Composite lagging a bit behind the S&P. Technology was sort of a little bit of an underperformer, but still up today. Let's see what else. The VIX is a little bit lower, back below 18. They've been testing that 20 level. And again, the rise in the VIX, a lot of people call the VIX the fear index, which I totally get the idea. If you think of fear, uncertainty, volatility is all kind of being synonymous, but that doesn't necessarily mean a bad thing. I would remind you that volatility on its own, by definition, is not, I don't think, good or bad. I think it's descriptive. It tells you the conditions about what we're doing. I think the direction of the market, the moves of the market, how it trades around key levels, and the overarching trends. I think that is the most important message. But the VIX back below 18. Looking very quickly at some other asset classes, bonds especially essentially flat for the day, really, with 10-year yields kind of remaining about where it was, around 117, 118. Commodities sort of choppy as well, with overall the commodity complex a little bit lower. Gold prices were flat, and silver, one of the few bright spots. Looking at commodities, energy, by the way, was the top sector in the S&P today. Cryptocurrencies overall, certainly more on the distribution side. Bitcoin, as we talked about on yesterday's show, coming back down from that 42,000 level. And I talk about Bitcoin as being range bound. Now, that's a monster range between 30,000 and 42,000. I recognize that is a big swing, but that is what the charts are telling you. We're in a volatile period between those two extremes. And I would say the long-term call on Bitcoin depends on which way we resolve out of that range. Either we break above 42,000 and signal a move to new highs, or we break below 30,000, which clears the way to a much lower move. I would not be at this point surprised by either of those. I think when a market is range bound, you focus on support and resistance and how we play around those levels. Let's talk quickly about a chart of the S&P. We'll hit on some other themes to wrap up our market recap today. So the S&P really right about at a new closing high. I don't know if it quite made it, but sort of right in that rounding error of testing it. Not a new intraday high. We were a little higher Thursday, I think, of last week. When we were up a little bit above current levels, but certainly we are at or near new highs. The momentum on the S&P right now suggests to me that we're a little bit at an exhaustion point, and it's the bearish momentum divergence that you see in July. It's similar to what we saw in April, similar to what we saw in January. Those two previous times, in both cases, we pulled back to the 50-day moving average. In both cases, it was about a 4 to 5% drawdown. Would be a little less, I think, to get to the 50-day moving average from here because of where we're at, having settled down a little bit in the current trading range. But overall, I think that's a decent base case to be made. However, we keep making new highs, higher lows are an uptrend, and I think we could have plenty of movement in here as long as we hold the 50-day. It certainly seems to be in a trend of higher highs and higher lows, and that would be the base case that I would pay attention to. Looking at sectors very quickly, we had energy number one, followed by healthcare. We talked about the healthcare sector, and I think it was on Friday's show, maybe Thursday's, one of our 3 and 3 charts at the end of the show was the healthcare sector, the XLV, making new highs again today. You're certainly seeing acceleration in parts of that space. We'll come back to Under Armour, which is actually a pretty decent chart, but I'm looking at Pfizer and others in the healthcare space that are accelerating to the upsides. The XLV was the chart that we highlighted last week, continuing to push higher, making new highs. The price highs are impressive to me, but consumer staples are in an uptrend as well. It's the relative strength in healthcare that's most important. That's what I would argue with sectors. It's really important to look at the relative strength line, because a lot of times the chart will give you one impression. The relative strength shows you whether or not you should be impressed by the price action. The improving relative profile of healthcare, making a new 6-month relative high again this week, I would argue is the most impressive part of that chart. It's driven by mega cap stocks like Pfizer, which are resolving to the upside, hitting resistance in this case from December, bouncing above there, finding resistance around 40 over the last couple months, and then pushing back to the upside, bouncing off of the 50-day. These are charts that are cleared uptrends. Moderna, by the way, up a decent amount today, up 11 to 12%. Actually reporting earnings on Thursday before the open, if I remember. I don't have the paper in front of me. I think it was Thursday before the open that they're reporting. So certainly a chart to pay attention to, but you're seeing strength in a lot of those, a lot of the groups within healthcare. We talked about medical supplies in particular, which is in decent shape for sure, and have been good long-term, has a good long-term performance run, but also seeing some of the pharmaceutical companies participate in that as well. Just very quickly, I wanted to check on biotech. So, one of the challenges we had with the healthcare sector was the lack of participation in biotech. And you look in the, February through May phase, you sort of pulled back to the 200-day moving average using the IBB here, sort of a sideways choppy phase, a consolidation phase before resolving to the upside. And I think this break above 160 on the IBB, testing that level of resistance from above, becoming support just above the 50-day, rotating back to the upside. The relative strength not quite making a new 3-month high, but that's something I would be looking for, a nice push higher. So again, a lot of the healthcare groups now participating, which is fairly constructive. Under Armour, really good chart. This is actually, I don't remember where I found this. Might have just been from the movers today, but UAA up about 7.25%, 7.4%. It looks like going into the close 7.5%. And what's interesting about this chart, fairly distributed, right? So in the short term, you had lower highs, lower lows below the 50-day moving average in the last couple of days. We've now rotated back above it. Today's close actually puts us above the June swing high. So as we've talked about many times, right, it's all about the highs and the lows. And a chart like this making a new swing high, very impressive. For me, at some point, we have to pull back, and you'd love to see us make a higher low above 1850. I think that would confirm this rotation from distributive to more accumulation phase. And that's something I would be looking for on the chart of Under Armour, but impressive to see this break above swing highs. That's what the beginning of a recovery phase starts to look like on a chart like UAA. Let's take a quick break. We'll be back with my guest, Andrew Thrasher. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Really appreciate you joining us every weekday after the close as we focus on actionable charts from our review of the market environment. A couple quick announcements before we get to my guest, Andrew Thrasher. Number one, we'll be doing a mailbag segment later in today's show. We'll do another one at the end of this week, and we would love to hear from you. Any questions on technical indicators, on particular charts, ratios, breadth, sentiment, anything is fair game. You can get your questions to us 3 ways. One is via email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on the Stock Charts channel. We'll gather all those questions and hope to answer one of your questions on Friday's mailbag segment. Also, as a reminder, go to stockchartstv.com. Use your email account, set up a free account on that website, and you can start watching all of our great content from the website. Fantastic shows like the Final Bar, special events like The Pitch, and charting the second half, and wonderful guests like Andrew Thrasher and many others. Go to stockchartstv.com or go to the App Store on any of your mobile devices and just search for Stock Charts TV on demand. I want to welcome on today's guest, Andrew Thrasher. Andrew's a portfolio manager at the Financial Enhancement Group and also the founder of Thrasher Analytics, coming to us from the Midwest in Indiana. Andrew, despite being a Purdue alum, it is a pleasure to welcome you on the show today.
I appreciate looking past that and letting me come back on. Thank you.
I say that with a great deal of respect. I have good friends that went to Purdue, and it's a pleasure to have you on, Andrew. Andrew, you do a great job of sharing charts. I always tell people, sharing charts that make me think, that help to put things in context. And you're starting with an area of the market I think a lot of people have been focused on, which is really the strength in commodities, now a bit of a tapering off, and then that implication for other markets. We have a chart here of EM and the CRB, the commodity index. Talk us through this one.
Yeah, I think the emerging markets have gotten a lot of attention after they have had some weakness kind of in the last couple of weeks, couple of months, where they broke back below those 2008 highs, and now they've actually broken below the 2018 highs. And one of the markets is, so when market begin to break down like that, I say, what are the biggest implications? And one of the other hot topics for 2021 has been commodities. We saw lumber earlier this year spike higher, corn prices. Recently, we had coffee futures started to really move higher. And some of those have started to give back. Actually, corn is down 20% over the last month. Energy has started to struggle. Crude oil futures are down about 6% over the last month. And so when emerging markets begin to break down, I think that's can often be a good leading indicator for the commodities market. And that's kind of what this chart shows here with the 2-month correlation on that bottom panel, that when that correlation begins to break down, and when that's occurring as emerging markets are weakening, then we've often seen commodities begin to struggle going ahead further beyond that. And that's what those blue lines show. And so I think we've had such a focus on inflation. Are we seeing, is it transitory? What's the Fed going to do? I don't pay a lot of attention. I don't try to predict what the Fed will do. But as far as is inflation transitory, or is inflation going to spike higher? I think from a commodity standpoint, I think we've seen a big chunk of the run already occur. And I think if emerging markets continue to weaken from here, then I think commodities are going to be put under pressure, as some of the individual future contracts already have been.
A great chart, Andrew, and I've often told people to, one of the key questions to answer is, find ways to anticipate when the trends may be exhausted. There's no doubt you've had that run in commodities, but could be an indication here that we get a bit of a rotation lower. Now, your second chart is looking at the S&P 500. We talked earlier in our market recap about this, overall uptrend, the S&P, testing almost new all-time highs again today. What's your take on the S&P here?
Yeah, we got a new high today by, I think it was like almost a 1 point. But the theme for 2021 of what I wrote in my Thrasher Analytics letter on Sunday was it's been a failed test and hold. We've been making new highs. They short-term fail, they come back, test that 50-day moving average. That's held, and then we continue to make new highs. And that theme has continued to play out. And for the first part of the year, we had really strong breadth. We had a lot of stocks above the 50-day moving average. Advanced decline lines looked great. And then that story started to change around May and really in June, where we started to see kind of a falling off. And I know that's something you've talked a lot about, a falling off in stocks above the 50-day moving average. And also something in that bottom panel, the number of stocks that are down at least 10%. So just because a stock is below its 50-day moving average, maybe it's because the moving average rose above price. Maybe it's the price just started to stall, kind of like what we saw with Amazon, where it really wasn't doing anything for several months. But when stocks started to go down, when we have stocks in a correction, 10% or more declining, that's a little bit more of a concern. And we started seeing that number rise from being around 20%, getting up to the 40s earlier this month. And so I think when we keep having these tests of the 50-day, that theme continues to play. The internals of the market really are starting to weaken. And I think it's going to eventually, if that continues to play out, then we're going to have a kind of an instance where if you were jumping on a glass ceiling, you keep jumping, it's going to crack and you're going to fall through. And that's what I think could play out if we continue to see a rise in stocks that are down 10% and a continued weakness of stocks unable to recover that 50-day moving average. But so far, like you said at the start of the show, the trend is firmly up. We're continuing to hit new highs. But each time we test that 50-day moving average, I want to kind of reevaluate and what's the internals look like. And right now they're starting to weaken, but that trend has yet to break.
It's a fabulous chart, and you've hit on, again, one of the things we've talked about is just this consistent support that the 50-day moving average has provided. Let's assume at this point, Andrew, that the price comes back and retests the 50-day yet again. What would be the signal that would tell you, okay, this uptrend is now exhausted and now we need to start thinking much more defensively? Is it as simple as a break of the 50-day, or is there a certain S&P level that would tell you, take your foot off the accelerator, start thinking more about risk? How would you approach that?
Sure, we can divide the market in two parts, in the sense that we right now we have, like the chart shows, is that we have stocks aren't all going up. But the other question we have to ask, okay, if they're not all going up, are they starting to go down? And so what I start looking at is the percent of stocks that are making 6-month lows, and stocks that are making 52-week lows. What I found is that when the S&P breaks its 20-day moving average, if we start seeing a really large expansion, and it's really didn't have to be that big, 5% is all you really need, 5% of stocks making 6-month lows, then that tells us that we really do have some deterioration internally. And historically, when we break that 20-day moving average and we have more than 5% of stocks at 6-month lows, then that's kind of where we've really started to see some major deterioration. Major highs like February 2020, fourth quarter 2018. You can go on back. A lot of the major declines really only started once we had that expansion of new lows. So to kind of answer your question, what I'd be looking for if we do start seeing a break of the 20 or 50-day, or get below that swing low from July, I want to look at the kind of the other side of the coin, not necessarily the stocks that are going up, but are we starting to see an expansion of stocks that are going down? And that would be my key indicator for the potential for further material downside.
Andrew, that's a great take. We'll have to leave it there. Listen, thank you so much for joining us today.
Sure.
Appreciate you sharing your thoughts. Stay safe, be well. Congrats on the new addition to your family. We'll talk to you again soon.
Thank you.
That's Andrew Thrasher. Andrew's a portfolio manager for the Financial Enhancement Group and also founder of Thrasher Analytics. And if you listen to how he answered that question at the end, I thought that was beautifully said. I asked about what you would need to see from the S&P 500, and I thought he pointed out at the breadth, it's not just how the fact that the S&P goes down. It's what are the conditions underneath the hood, basically, right? What are the conditions of the stocks that make up that index? We talked about the breadth conditions, some of the warning signs of the deteriorating breadth. We talked about the S&P and the percent above their 50-day moving average, the advanced decline lines rotating lower, and I think that's a great reminder that just the S&P breaking a level may not be enough to really get a good read on things. It's all about the conditions that are causing that down move in the S&P 500. Great take there from Andrew Thrasher. Let's continue on with our next segment, which is the Final Bar Mailbag. As I've mentioned earlier, we love hearing from you. And again, our email is thefinalbar@stockcharts.com. That is definitely the best way to get a hold of us. We would love to hear your questions and hope to answer one of your questions on our next mailbag segment on Friday's show. But here are today's couple questions. Number one, thanks for mentioning the Zweig breadth thrust earlier in the week. And this is from last week, if I remember right. And yeah, we did mention the Zweig breadth thrust. But basically, that is a phenomenon where you have a beaten down market, essentially, where the breadth has been very negative, and then it swings and turns net positive very, very quickly. And as you mentioned in your question, I'm paraphrasing your question, by the way, because there's a lot of detail in there, but you mentioned it's sort of like Pring's bottom fisher indicator, which we have on StockCharts, and the Hindenburg Omen, which you talked about as well. And I would totally agree. I think these are good sort of broad market phenomena to pay attention to. While I don't feel like it's the ultimate indicator as much as we may want something like that, I think it's an important data point. Your particular question, though, says, I'm trying to scan for these sorts of indexes using the scan engine, and none of those seem to work with those above indexes, all of which have symbols begin with an exclamation point. And I'll show you, let's see, the chart that I was going to show you. I'm now thinking I'm not sure where it is, so let's just bring up this one. The sign for the Hindenburg Omen indicator is this one. It is, let's see, BINYBT is this indicator down here at the bottom. This is what, so a lot of the indexes that we have for the breadth thrust and others start with an exclamation point. So this is the Zweig breadth thrust indicator, and it went below 0.4, and as long, if it gets above 0.62, 0.63 within 10 trading days, that's the indication that you've had a big swing from negative breadth conditions to very positive breadth conditions. By the way, we've not yet triggered that. So the short answer is no, we don't have a way to incorporate those in the scan engine. The good answer is I'm so thankful that you wrote that, because we are talking about what our new scan engine that we're going to be developing here, what it needs to include. And that was a great reminder for me and other members of the management team to include some of those indexes that we have, some of the breadth data. So I would love to say that absolutely we're going to do it. We are going to take a look and see how we can incorporate them. But no, our existing scan engine really works on listed securities. So things that start with the dollar sign are just the regular tickers, stocks, ETFs, indexes, all work in there. We don't have some of the breadth data and things that you mentioned coded into our scan engine yet. More to come for sure as we take a deeper look at our scan engine. Next question, would it be possible to do an in-depth analysis of TWLO, $TWLO? The answer is yes. Jeff Hughes, who's one of my guests recently, talked about it briefly last week prior to earnings on the pitch. Oh, that's right. And it was great. Yeah, you're absolutely right. We talked about, I was going to say, I remember that ticker from Jeff, and it was on the pitch that we did recently, which was Jeff Hughes, Mark Newton, and Greg Schnell. It was a lot of fun, some really good thoughts there. And I loved each of their takes on how to approach things from a stock picking perspective. Twilio is an interesting one. This is one that I think is really at a key decision point, which is why I'm glad Jeff had brought it up. The long-term trajectory of this, I think, is encouraging. And I would say that on the fact that it had been in a clear accumulation phase really through the February peak, then went into more of a distribution phase, dipped below the 200-day moving average there in May, then started to rotate back higher, made a higher low in June, a higher low again in July. Now it's back testing that swing low. And so I think it's at a key point. So now we are caught between sort of two opposing forces. On the downside, we have the 50-day moving average. We have the July low, which is right around, we'll call it 360 or so. On the upside, around 400 is the resistance that we had from April, and that we've now bounced off a number of times. Now, I have to say, above that, you have around 440, which is the high from February. Below where we're at, We have 280, which is the low from May. Absolutely right. And I think if we break out one of those would be the next, next objectives on the upside or the downside. But I think right now we're at a key point. For me, it's all about, do we break this swing low from July? Do we break below 360? Do we break above 400? I would expect the next move to be in the direction of that momentum. And my short-term objective would be those levels that I identified: 440 on the upside, 280 on the downside. Again, this is a chart that is attempting to rotate higher. At this point, it's making higher highs and higher lows, which in my opinion means you give the weight of the evidence overall as positive until proven otherwise. And a break below the 50-day, a break below 360 would negate that bullish trend that we've seen in the short term. What do you make of, this is a longer question I paraphrased down to, what do you make of the seasonal trends in July, August, and September? If we'd had time, I was going to ask Andrew Thrasher, my guest today, about seasonal trends in the S&P, because we're sort of at that point where we're in the seasonally weakest part of the year. And if we go back to the last 20 years or so, you can see that if you look at this is the basically the batting average, what percent of the time the month closed higher than it opened. You can see that June relatively weak, July and August a little better, but you can see September and October tend to be, some of the weaker months on batting average. At the bottom is sort of the average move, and you can see it's also fairly negative here. So we're sort of in a weaker part of the year, and in general, November through April much stronger than May through October. So when we got to the sell in May, go away phase, but continued higher, I think that indicated that there was enough underlying strength to negate that seasonal tendency. But the weakest part of the year, if you look at it, is sort of August into September. August, you sort of have the summer doldrums, lighter volume, a lot of people on vacation. September is when a lot of market bottoms, September and October is when a lot of market bottoms have occurred. That's a lot of distribution has tended to happen there. And so overall, certainly weaker. So for me, seasonal trends are down the road of importance because, and I think of that with anything with cycles or anything like that that is based on historical tendencies. You have to remember those are tendencies. Those are not predictive, right? It's not saying, obviously, September is going to be weak because it usually is a weak month. All it tells you is it tends to be a weak month. For me, all that tells you is your bias should be thinking about risk, but at the end of the day, you have to follow the trend. So the market doesn't care what the seasonal trends are. I would focus on the trends primarily. So can the market continue to go higher every month and make higher highs through year end? It absolutely could do that. I would be very surprised if that happens just because of all the conditions that we've talked about on the show. A lot of the things that Andrew Thrasher, my guest today, shared, looking at some of the weakening trend characteristics and breadth concerns more than anything. So it is the seasonally weaker part of the year. We're in the weaker part of the seasonally weaker half of the year. All of that is true. At the end of the day, though, you have to follow price. And I'm going to stay with the market if the market keeps making higher highs and higher lows, which it is through today. We need to take the show to the end. The 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is the chart of Apple. 3 stocks that I picked today that I think tell a story about the current market. With Apple, this is a chart really, and again, I feel like with a lot of charts, I've said it's at a pivotal point, and I think that's actually really important. You have a lot of charts that are testing support and have the potential to really break down and go from sort of a choppy minor pullback to a much deeper drop, and the cyclicals in general tend to be that way, although a number of them bounced obviously today. With Apple, it's the question of, does this breakout hold? You had resistance from January. We came back up to that level and broke above it. That could be the opportunity, or should be the opportunity, given a healthy equity market, for Apple to go to much higher and continue to push to the upside. From there, though, we're in a bit of a pennant here, sort of a consolidation phase. You want to see if we're able to break above 150 on here. If Apple can break above 150, there's only so weak that the market itself can be if stocks like Apple are able to follow through. If it fails, though, I think that's a real tell on overall conditions. Caterpillar, by the way, a chart at a key moment. This is bouncing off of its 200-day moving average like it did in the month of July, about midway through it. Just bouncing off there a couple times over the last week. I think that's a key point. We're nowhere near the first Fibonacci support level, which was down around 184, but I think its ability to hold here would be key, and a nice bullish momentum divergence as well. Might be good upside opportunity. Third, I mentioned Under Armour. And again, I like charts that are rotating above previous swing highs. Follow charts like that. Ladies and gentlemen, that's our show for today. Special thank you to Andrew Thrasher joining us from Indiana. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.